The combination of low unemployment and a high volume of job openings was hard to predict when inflation peaked at 9.1% last June. Some economists thought the only way the Federal Reserve could reduce prices was by raising interest rates and creating a recession. Although interest rates have increased drastically in the last year, the recession hasn't happened. In fact, in a recent survey of 143 of the nation's top CEOs, two-thirds say they expect their company's sales to increase, and more than 70% expect their employment numbers to stay the same or to go up. The responses indicated economic expansion rather than contraction or recession. Here to help us break down what is and isn't happening with the economy is Ed Yardeni. He's president and chief investment strategist at Yardeni Research. Ed, you've said that you haven't seen evidence of an economy-wide recession, but rather a, quote, rolling recession. Tell me what that means.
Right. Yeah, well, I think we have been in a recession. It's just a rolling recession means that it hits different sectors of the economy at different times, and other sectors are doing pretty well. So, for example, we know that the housing market is in a recession. However, to be exact, we know that single-family housing market is in a recession. Multifamily is actually booming. There's a lot of multifamily starts going on. We know that the goods sector did very well coming out of the pandemic, but then once everybody got over their buying binge for goods, the consumer shifted over to services, and a lot of retailers got stuck with inventories that they didn't anticipate, very much like what happens in a recession. I think we can anticipate that the commercial real estate market is about to go into a recession now. But overall, it's hard to get a recession when the job market continues to expand.
And tell me what that characterization of a rolling recovery, how that helps us understand the economy more broadly at this moment.
Well, this is not really the first time that this has happened. In the mid-1980s, there was a tremendous drop in the price of oil, and Texas and Oklahoma really got hit really very hard. We had another rolling recession that hit us in the early 90s when the savings and loan industry fell into a recession. But overall, the economy proved to be resilient in those two past experiences, and it's proving to be resilient once again. I think the recovery means that we're not going to have a recession with significantly rising unemployment. But the key, of course, is that inflation continues to come down, which I think it will. And also the key is that the Fed concludes that rates are where they want them to be at a restrictive level, but not the restrictive so as to choke off the economy.
So speaking of the Fed, they'll meet next week to make their interest rate decision. Rates have gone up 10 times since last March. What's your expectation with what they'll do next time? And then what's your outlook after that?
Well, I guess there's always some controversy about what the Fed's going to do next and what they're going to do beyond that. There has been, I think, a consensus view that developed that the Fed might skip a rate hike at the next meeting and then save it for a July increase for the July meeting. I think that they're going to do exactly that. I think they're going to be cautious. They realize that the banking crisis we experienced in March is not something that they want to really push much harder. I think they realize that there's long lags between their tightening and their impact on the economy. We know that, for example, as I just said, commercial real estate is a recession that's going to be playing out in that industry for the next several quarters. And they know all that, and I think they're going to give it a rest.
We've had such an extraordinary period with the pandemic and the economy and coming out of it. There have been a lot of predictions including from the Federal Reserve, that haven't turned out to go the way that those people making the predictions thought they would. As you look at the economy, is there an aspect of it that you think is the most important to understand what's happening right now and what's going to happen in this next period?
Well, I think you got it exactly right. Macroeconomists have their models, both theoretical and econometric models, statistical models. But we have to really recognize that something occurred that was really different, and that was the pandemic. The pandemic was a huge shock. We haven't had anything like it. The last global pandemic was in 1918. So here we experienced this global pandemic. It was a shock, and there's been many aftershocks. And I think we're still kind of getting through those aftershocks. one of the shocks was that it led to more inflation than anyone anticipated. But we are, in fact, seeing that inflation's making a round trip when you look at consumer goods, particularly durable goods. I know it doesn't feel like inflation's coming down in food, but it's not going up. And so when we make inflation comparisons year over year, that's moderating. And we're still left with services, particularly rent. But even there's signs that that's moderating.
All right. Ed Yardeni, President and Chief Investment Strategist at Yardeni Research. Thanks so much for being with us.
Thank you, John.